power of the dip buying's been, it's pretty, that pattern is pretty powerful over the last, 3-4 years. So you're going to have those dip buyers. But we run Joe, at the Bear Traps Report, we run a live chat with about 600 institutional investors, and it's one of the largest platforms. And so we're constantly engaging them on a daily basis. And if you talk to institutional investors, traders, CIOs, they clearly think this action over the last week is Fed-driven. They think that COVID is backward-looking. I know a lot of the media wants to, not necessarily you guys, but the media wants to keep COVID. It's a health issue, it's a national security issue, so it's important. But at the end of the day, institutional investors are looking forward, and I think that we're setting up for a 2018 type shock where it's Fed against the beast in the market.
Larry, we had a conversation with Steve Leisman yesterday about that the terminal interest rate that is now expected from the Fed is lower than many people would have thought, and maybe that's bullish. Maybe we don't need to go back to some of those levels that we saw before. I've had some other people tell me that after a splurge or after a party like it's 1999, after what we've seen the Fed orchestrate over the past 7-8 years, that has caused what some people think are very large asset bubbles, that we've seen this movie before. When that pops, the growth the next couple of years could be dampened, and inflation could remain low, even though no one's thinking that. But look what happened to Japan. Look what happened back in after the Roaring *20s. Do you think there's anything to that we're in this roach motel we're not going to be able to get out of? And fiscally, we're not exactly tightening our belt.
Well, keep in mind, Joe, the Fed uses the street. So your viewers, we're constantly I think the street's like a pawn, right? So if the Fed needs to move the street expectations up, they'll leak. If you notice last week, they leaked to Goldman Sachs, someone at the Fed, about a more aggressive cash posture, potentially doubling the speed of the taper, 3 hikes next year instead of 2. And then Powell comes out on Tuesday and says that. So it's very strange that an investment bank knew that 4 days in advance, almost a week in advance. And so what Powell's essentially doing is he's trying to give himself some dry powder in case he needs more dry powder in the next year. But at the end of the day, Joe, think about this. 3 rate hikes next year, plus a full taper, plus at least $1 trillion fiscal drag coming out of Washington. This year we did close to $3 trillion of deficit spending. And you've got the mansions out there. Next year, maybe the deficit's 2, 1.5. So if you add it all up, it's a colossal fiscal and monetary hit to the economy. And to your point, asset prices are so high, they just can't take it. We're probably going to go down 20, 30% here into the Fed meeting or around maybe until January, until the Fed backs away as they did. Remember, in 2018, Joe, this is so important. 2018, in the fourth quarter, the Fed convinced Goldman Sachs that they were going to hike rates 4 times in 2019. 4 times. They convinced Wall Street. In 2019, they had to back away and actually cut rates twice. So they didn't hike 4 times, they cut twice. So they used the street like pawns, and we have to be aware of that.
It's a little bit hard to figure out how we're used to talking about how much money printing there's going on from central bankers, and that inflates assets, and this is what we're talking about, that could eventually pop. When do we see, if we're actually going to have slower growth when the asset bubble pops, when do we see all of that money printing come home to roost in terms of hyperinflation? I don't know, what does that come first, and then there's a slowdown in economic growth? Or look, Japan never had hyperinflation, even after an asset bubble. So I don't understand how it doesn't seem that you can jibe both sides. Slower growth because you've inflated assets so much without and then a long period of deflation or disinflation.
Yes, exactly. The debate on inflation is so powerful, bulls and bears. And at the end of the day, when inflation spikes as much as it has, it's very deflationary. That's why the 30-year has rolled over from like 2.4 down to 1.8. And so essentially the Fed is already, because of inflation, we've already inflicted some rate hikes into the market. In other words, the demand destruction of inflation has slowed down the economy dramatically relative to where we were six months ago.
Shepard Smith here. Thanks for watching CNBC on YouTube.